Hi there, fellow investors. Deckers Outdoor stock just dropped 12% after earnings, even though the earnings per share beat estimates by a wide margin. So markets are freaking out, whereas the company is delivering good results. And I dug into the numbers, and I actually think this is a good opportunity because whereas the stock price goes down and down and down, the company actually is improving. So today we're going to cover the most important news from the earnings call. And the second point, we're going to cover why investors are concerned. And in the third point, why I am actually optimistic and why I keep being optimistic. And I will show you my metrics and the development of the company for this. So let's jump right in. So why are investors worried? This is the press release released by Deckers Brands regarding their earnings. And as we can see, it's everything basically good news. Second quarter fiscal year 2026, revenue increased 9%, diluted earnings per share increased 14%, way above expectations to $1.82. It's basically all good news or mostly good news. But when we scroll down further, we can see why investors are worried, and this is the full fiscal year 2026 outlook. And here they state that among else, for example, changes in macroeconomic conditions might negatively affect the business, including consumer confidence, discretionary spending, inflationary pressures, and foreign currency fluctuations. And more specifically, changes to global trade policy, including tariffs and trade restrictions, geopolitical tensions. And these are the reasons they state for the following numbers. And they state that net sales are expected to come in at $5.35 billion in fiscal 2026. And this is around $100 million less than analysts had expected. This is why the stock decreased, because the outlook was more cautious than analysts had hoped or expected, and investors as well. And of course, more growth is better than less growth. So I get that investors are not happy here, but $100 million less is something. I don't want to say it's a good thing, but having a look at these reasons that they state, we can see that all of these reasons are external reasons. So there's nothing internal, like business-wise, that would affect the result negatively. And what does this mean? This means, okay, external factors do affect the business. They have a real effect on the business, but once they're gone, the business goes back to usual. The results will improve actually again. And another point is that every competitor in the field is under the same influence here. These external factors affect everybody in the field. So once these factors reverse, then the results will improve again. And especially in the long term, like for example tariffs. If tariffs stick around in the long term, the company will adapt to these tariffs and they will shift production maybe somewhere else where it's cheaper. Anyway, they will find a solution. And if tariffs do not stick around, well, then costs are going to go down anyway. So in the long term, external factors here don't matter as much. Now let's have a look at some metrics here again. I also showed these to you in the other video I made on Deckers Outdoor. Feel free to check it out and compare the results. The link should appear in the corner right now. So revenue, as you can see, has constantly gone up. And this is the main worry of investors right here, that the revenue is not going to grow as fast. But what are we looking at here? Revenue has constantly been growing every year. Yes, growth has come down, but even for fiscal 2026, it is expected to grow 8 to 9%. So it's a little lower, but in 2027, it's expected to pick up again. So I don't see in the long term a real effect on the business here. I mean, yes, it's a little more conservative, but Deckers has a reputation of beating estimates, so I'm not worried here at all. And especially a drop like this in the stock price is not justified in my eyes. Earnings per share, nice growth here, a little slower in fiscal 2026, but again expected to pick up in 2027. So we could take this opportunity of the cheaper price, and for the next 5 years the price should pick up again. So this little flat data point is actually an advantage to investors right now. I think free cash flow is expected to go down here in fiscal 2026, but again it's supposed to pick up again in 2027. So yes, this is flat, but I'm convinced that it's going to recover. As you can see, the growth rate is picking up again, and this is the expectation. What else do we have? Debt to equity ratio is actually coming down. So this shows me the health of the business. PE ratios way below the 5-year mean, so that's a good sign. Well, it's actually cheap at the moment, and the PE ratio for the next 12 months also below the 5-year mean, and at 14 it's as low as it's ever been, basically. So I think this is a good time to buy the stock. This statistics right here also convinces me. They are showing me that the return on invested capital is actually picking up steam, is way above the 5-year mean. So they have a very profitable business going here. And all these metrics are pointing in the right direction for me. Yes, a little bump in the earnings per share momentarily, a little slower growth in revenue. We still have a growth here. It's just a little slower, and that the stock goes down like 50% or 60% from its all-time high, I don't think this is in any correlation with what we see here. So as I showed you, the stock price has known only one direction for a while, which is down, and then the stock is down 50 or 60% from its all-time high. But all the internal metrics on the business are pointing in the right direction, which is up. This is a disconnect that we can take advantage of as value investors. And let's have a look now at the intrinsic value calculation that I updated specifically for this situation. Now again, let me emphasize that of course it's not a good thing that there's less growth than expected, but it's not as tragic as the market thinks it is. So of course, I updated my calculation here for the free cash flow. I put in 750 million. Before it was like between or around 850 million in free cash flow. But everything else I kept the same, because these are still the numbers that are out there. And as you can see, they still have a lot of cash. It's 1.5 billion and total debt is 270 million. So they could pay off the debt right now and still have a huge chunk of cash. And they are actually buying back shares with this cash and this returning value to shareholders. All right, these are my scenarios. You can pause the video if you like to have a look at them. And what I get here is an intrinsic value of $150. Current price sits at $90 in after-hour trading, including a margin of safety. I get an intrinsic value of $104, which is visibly higher than what is that, like 15 to 20% higher than the price of $90. And in the worst case scenario, the stock goes down another 12% to about $78. So we are already at the lower end of the range, but in the best case scenario, the stock goes up 180%. And I think like risk and reward wise, we have a really good setup here that we can take an advantage of. We might wait, of course, 3 to 5 years until this materializes. But I think from what I showed you, the business is doing very, very well. And this is just a flat year they're having basically. And as contrarian investors, we can take advantage of this if we have the patience to wait the 2, 3, 4 years until this materializes. So this is why I'm optimistic about the company. This is why I think it's a good opportunity right now, because the stock price is very low. It's very cheap for what you get. And if anything, I might add to my position that I already have. Let me know what you think about the stock. Are you buying more at this price? Are you selling? What do you think is the intrinsic value of the company? I would be interested to know that. So feel free to leave a comment down below. Please also leave a like and subscribe to the channel if you like more stock analyses like these. Thank you for tuning in today, and I see you in the next one.